This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Jeff back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Jeff's picture saying, looking for the downloads. Now, Eric, what are your thoughts here on these equity markets?
Well, the sell-off this week has taken us right down to key support at the 100-day moving average, which is right around 5,996 on the S&P. We tried to bounce off it on Wednesday early session, but then Trump tariff talk brought us right back down to close right on that key level. And as I'm recording early on Thursday morning, we're trying once again to bounce above that level. Is it going to be a dead cat bounce, or are we looking at the beginning of a recovery here? It's a little bit too early to tell, but that's going to be the tell, is whether or not that 100-day moving average will hold on the S&P. So I see this as make or break it time for the S&P, with a further breakdown from here being marked by a close below that 59.96 level. If that happens, we could easily see a much bigger correction all the way down to the 200-day moving average, which is way down at 57.55. That's 5755. Quite a few notable investors, Stephen Cohen and others, have been calling for that deeper correction. They say it's in the cards, so I guess we'll see what happens. Right now, the number to watch, though, is a daily close below the 100-day moving average, which is right around 5,996. A close below that level would likely beget more selling.
So, Eric, when looking on page 2 on that S&P 500 chart, I have that 50-day moving average on there, and we've broken below the 50-day. And when you look back at the last year of price action, we've had like 4 occasions where this has occurred. It's been these like 5% market corrections that often occur and numerous times throughout a year. But the bigger question, is this just one of those little market corrections, or is it something more bigger? Well, the first observations to make is that there's considerable momentum loss in the markets. We've more or less spent 3 months trading along a key highs as the market has lost upside momentum, and a large amount of that has come from where on page 3 I can have the Magnificent 7 ETF chart where the Mag 7s have broken down. Now, those Mag 7s are such a huge component from a market cap weighting perspective in the S&P that when they're correcting, that the S&P index is dragged down or is very heavy or tired simply because the other stocks have a very hard time compensating. We still have not seen the market breadth widen, and so there's been sector rotation. So as money managers are clearly lightening up on many of the Magnificent 7 stocks, we have that money coming into consumer staples, finding some pharmaceuticals. There's underpinning rotation in the market, but that is likely to leave the market very heavy. Now, we got through NVIDIA's earnings without any big drama, but the puzzle to solve now is will they be able to have these Mag 7s have any rebound based on that? Because if the distribution on these stocks continues, it certainly can spiral the S&P into a little bit of a deeper correction in the weeks to come. Now, Eric, I want to touch on that U.S. dollar index. What are you thinking here?
The move lower continued this week, sealing the deal that the prior consolidation range from a 107 to 110 has been broken to the downside, and suggesting that the top might be in, at least for now. But there are quite a few potential upside catalysts that could emerge to change all of that. So at this point, I think we're in a new downtrend on the Dixie. I think maybe the short-term top is in, but my conviction for still lower numbers is tentative, at least for now.
Well, Eric, there's been plenty of talk out there as to whether the U.S. dollar is putting in a major top and whether they can orchestrate a period of U.S. dollar weakness. But I like to keep things very simple. There's a primary bull trend in the U.S. dollar that started back in the third quarter of last year. And this rally that we have seen has just paused, and that is a very typical price action on almost any asset. And so when we have this type of a pause, it's approaching a very key support line along what were all of its previous highs in the 2023 and 2024 years. Often that acts as support. There's a lot of reasons to still leave the door open to another leg higher in the market, whether it's just retesting the highs or even another leg higher. There just simply isn't enough price action deterioration in the charts to suggest that there's a major new US dollar downtrend underway. Now, Eric, let's move on to crude oil. There continues to be this consolidation on the downside. How do you size this up?
The 100-day moving average at 70.11 on WTI was key technical support, and when the market broke below it on Tuesday morning, the selling accelerated. As of the wee hours of Thursday morning, the low so far on WTI was 68.40, and we're bouncing very nicely off of that level now, looking at just over 69.20 as I'm recording early on Thursday morning. I won't be surprised to see still lower numbers to come. It seems like politically that's what a lot of powerful people want to make happen. But there's also the risk of something going wrong in these peace negotiations and seeing a Middle East geopolitical escalation, which could easily rocket numbers much higher on oil. But barring that, I think a drift lower is entirely possible now that we've taken out that key support level at 70.
Yeah, Eric, well, to me, back about 2-3 weeks ago when we were testing the $72, $73 area, that was a very important line in the sand for me for a bull continuation pattern. When those levels failed, it's clear that we fell back in to the trade range that was established in the second half of last year, which has that lower boundary of like $66, $67 and the upper boundary up in the $72, $73 area. It's likely in my mind that this trade range will prevail for the rest of the first quarter. Now, will that support hold? Will this be where the base of crude oil establishes itself? Those are the little puzzles to solve. But right now in the short term, oil remains stuck in this purgatory trade range. All right, Eric, let's move on to gold here.
Well, Patrick, gold has been flashing extreme overbought on the RSI for weeks now, and it's finally consolidating to shake off that overbought condition, with the daily RSI finally falling back down below its midpoint to 44 early on Thursday morning. But the weekly RSI is still a concern. As of Wednesday's close, it was still flashing massively overbought at a whopping 87. So far, the 21-day moving average has been what's held up this market, but we sold off below that overnight on Wednesday and into Thursday morning. After testing 2889 in the overnight session, we were bouncing off of that, struggling to hold just barely 2900 an hour into the European session on Thursday morning. That's still just below the 21-day moving average, which is at 2905 now, and if we can't close above that level of 2905 on Thursday, there's a good chance of another leg lower. Looking at the daily RSI, the downside probably shouldn't be too bad because, it's already halfway over. It seems like we're halfway there. We haven't been down that much, probably don't have that much to go. But the thing is, that's the daily RSI. When you look at the weekly RSI, it tells a very different story. It's just starting to roll over from extreme overbought. It's showing 83 on Thursday morning, down from 87 at Wednesday's close. So the weekly RSI is telling us that there's room for a significant downside correction over the next few weeks if that consolidation range just above 2890 doesn't hold on Thursday. So I'll definitely be watching Thursday's close. If we can get nice and comfortably above that 21-day moving average, probably the consolidation range is holding for now. If we close below 2890, that says to me that maybe significantly lower numbers are still in the cards. So I'm on the fence between a continuing trade sideways in a consolidation range between 2890 and 2965, which is what we've been doing for the last week or so. And that's if the daily RSI falls back into oversold territory, which should set us up for at least a bounce higher, a swing trade higher towards maybe making that 3,000 target that everybody's watching. Or we could see the weekly RSI is telling us that maybe that deeper correction is coming. Again, 28.90 is the pivot level that I'm watching for a daily close below to tell me that a significant move is on to the downside.
Yeah, Eric, in my mind, gold as well is reached the upper boundaries of some of the target zones. So typically the normal ebb and flow of market movement is it makes a bullish impulse and then pauses and consolidates that. It's increasingly likely that some form of a gold consolidation is likely to develop here. That doesn't make me bearish gold. It's simply about having realistic expectations of how long and how far a gold impulse can go. It's more likely that a major breakout in gold above 3,000 now is looking increasingly at like a second or third quarter story. Now, Eric, let's move on to uranium, where the U308 continues to show some weakness, but the underpinning conditions are not necessarily confirming that. So what are your thoughts here?
Well, Patrick, yet another week of extremely bullish nuclear news flow with Energy Secretary Chris Wright visiting both Los Alamos National Laboratory and also planning a visit to Oak Ridge National Laboratory, two of the biggest and most important nuclear research laboratories, and then telling CNN that he is excited to launch an American nuclear renaissance. Policy signaling doesn't get a whole lot clearer than that. Then an absolute majority of the Spanish Senate passed a resolution to halt the planned closure of Spain's nuclear fleet. Then Holtec announced its plans to build two more 300-megawatt SMRs on the same Palisades site where an 800-megawatt reactor is already scheduled to be restarted. So Palisades alone represents 1,400 megawatts of electric generation capacity that will be coming back online in the next several years, and that's going to require fuel that has not previously been budgeted for. And then the German chancellor called for halting the phase-out of nuclear energy in that country. So they're going to stop turning it off. Now, they haven't quite gotten to the point of agreeing to turn it back on. That's restarting the reactors that they'd already shut down, or that the Green Party there had already shut down, the party that was just voted out of power. But this was an essential first step in that direction. So, wow, Patrick, with all of those things taken together, you really couldn't ask for more bullish fundamental news flow for nuclear energy in a single week than what we got just in this past week. Yet still, it's been another week of spot uranium and uranium miners plumbing new cycle lows, defying the bullish fundamentals, with many issues making new lower lows below their September 6th lows, which so many people thought was going to be the bottom of this secular bear market in uranium. The catalyst that started the selling frenzy on Friday was the general manager of Orano, that's the French state-owned producer, reassuring his customers, don't worry, everybody, there's not going to be any uranium shortage interfering with our deliveries in the short term, in the medium term, or in the long term. Now, his statements were made very dramatically and very emphatically, as the French are prone to doing, despite the fact that it was not supported by any kind of data or analysis or rationale to explain why he was saying that. And it seems like that's what spooked the market. Now, to my thinking, this is strong evidence of how fragile investor sentiment has become in this market, but nothing else. He didn't say that there wasn't a structural supply deficit, which there most assuredly is. All he said, Patrick, is that they would be able to make their deliveries just fine. And he's right about that. Now, he neglected to mention that prices will almost certainly need to move much higher in order for his promises to be kept, which I'm convinced that they will. And look, at the end of the day, he's the manager of a state-owned enterprise who said nothing other than to reassure his customers that they're not going to run out of metal and be unable to deliver on their contractual obligations. What else would you expect the manager of a state-owned producer to say? He didn't cite any supply statistics or otherwise support his statement with data, so the market reaction, frankly, didn't make any sense. Next, we got more talk from the Trump administration suggesting that they're edging closer and closer to making amends with Russia and bringing an end to the Ukraine war, which the market seems to have taken as bearish for uranium, I guess because apparently they think that Russian supply coming back on the market, if the sanctions are lifted, could result in an oversupply supply that would flood the market and result in a downward price shock. Look, I think the market has that one exactly backwards. What Russia has more of than we have in the West, and what the West urgently needs from Russia, is their conversion and enrichment services. Not their raw uranium, but their capacity to convert and enrich uranium. So I think that lifting of the Russian sanctions might actually be bullish for U3O8 because the present bottleneck caused by a shortage of Western conversion and enrichment capacity might be addressed. But frankly, I doubt that would even happen because I doubt President Trump is going to lift those import bans since they seem to conflict with his America First policy objectives. But still, the retail freakout that happened anyway, despite it not making any logical sense, definitely underscores the fragility of investor sentiment in this market. Now, I bought the dip on Friday, I bought more of the deeper dip on Monday, and I bought a whole bunch more of the even deeper dip on Tuesday. We tried to bounce on Wednesday, and it looked like the swing bottom might be in already, but then Trump's further announcements suggesting a deal to end the Ukraine war might be close at hand brought most issues back down to close near the lows of the day. The real elephant in the room, as far as I'm concerned, is the risk of a broader market risk-off event. If the S&P dumps another 200 points, it's a sure bet that we'll see even lower prices on the uranium miners. And that could lead to margin calls for over-levered retail tourists, and even more panic selling would ensue. So while there's no doubt in my mind that the process of retail capitulation that often marks market bottoms is now well underway, I'm still not at all convinced that the final bottom is in. There's still plenty of room for an outright washout if the S&P enters a deep correction from here. If that happens, it'll create a generational buying opportunity for uranium and uranium miners because, again, the question to ask yourself in these scary downside oversold situations is, have the fundamentals changed? The answer is yes, they have changed. They've gotten even more bullish. So this is a buying opportunity already. It might get even better of a buying opportunity if a deeper correction in the S&P carries uranium even lower, and I think that could bring about a margin call induced real panic sell if it happens. So brace for impact in case that broader market risk event should happen. But if it doesn't happen, we're probably already very close to the bottom now, at least in the short term. The RSI hasn't been this low since September 6th, and we got a nice 40% rally off of that low. Bottom line, watch the S&P for the tell on what comes next for uranium.
Yeah, well, Eric, on page 7, I have that Sprott Physical Uranium Trust, and that continues to make lower highs and lower lows in an active distribution, selling at a deep discount to its net asset value, looking for where that selling subsides and where we start seeing basing formations for the potential turnaround story. At this stage, we're still more than $1 away from the just a simple thing like a 50-day moving average or beating the descending trend line. And so there's a lot of repair work that has to be done before we get bull signals on this. Finally, though, Eric, I wanted to just touch on the chart on the T-bond futures. And bonds have obviously spent the entire back half of last year in a very decisive downtrend. And after establishing that, we're really starting to see bonds come to life. We had a legitimate breakout in the last week on the upside of these bonds, and they're now breaking the descending trend lines, getting above the moving averages, asking the question as to whether we've seen a peak in yields and a low in bonds, and whether or not they can counter trend here in the weeks and months to come. Certainly something that's on my mind.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.